I don't know if this rally that we've seen hitting new all-time highs is still the complacency phase, or if it's a new beginning of, I don't know, an optimism or euphoria phase, right? Is that
Yeah.
basically, are we still there?
Yeah, I believe we're still in this this kind of complacency topping phase. And the complacency really is like that optimism belief. It's that they're complacent. They don't realize this is kind of like a rally going up. And I do believe we're going to see this market have a massive correction this year. And
Stock markets just hit a new all-time high. Will this momentum continue? We're going to find out today with Chris Vermeulen, Chief Market Strategist at thetechnicaltraders.com. On a personal note, I'll be attending the Vancouver Resource Investment Conference where I'll be moderating panels and doing interviews there. So if you want to check me out, click on the link down below at the Vancouver Resource Investment Conference. And if you're in Vancouver, I'll see you there this weekend. And a word from our sponsor, CoinLedger, before we hear from Chris. If you are a crypto investor, then you know how cumbersome it can be to report your crypto transactions on taxes. There is a simpler way. CoinLedger is a crypto and NFT software which does your tax reports for you. Just sign up for a CoinLedger account and link your crypto wallets to it. That's all there is. CoinLedger will then automatically generate a tax report for you based on your transaction data. This tax report can be sent to any tax filing software, TurboTax, TurboAct, Wealthsimple, etc., or just passed on to your accountant. CoinLedger's tax report will be even generated in your local currency if you choose. The software supports DeFi and NFTs. CoinLedger is the highest rated cryptocurrency tax software platform in the world right now, which is why over 500,000 investors already use CoinLedger to help file their taxes. Use my promo code with the link in the description down below and start saving time on your tax filings with CoinLedger. Don't get caught off guard this tax season. First time on the show in 2024. Chris, welcome back. Happy New Year.
yeah, Happy New Year to you, David. Thanks for having me.
I know you're off traveling, so I appreciate you coming back on the show in early January, or mid-January now. Let's talk about what's going on right now in the markets. You and I were talking offline about our last conversation, which we'll link in the description below. You were telling us about a sell-off this year that is going to be, pretty bad for most asset classes except the US dollar. We're going to get to that. But first, let's talk about the financial markets, the equity markets in particular. The S&P 500 hasn't really corrected that much yet. People were expecting a huge sell-off in January and February because of how far it's run up late last year, but it hasn't done that yet. Let's take a look at the charts, Chris, and see whether or not momentum is still on the upside.
Sure. All right. So if we take a look at the charts, the markets have been really on a tear all of 2023. We have the SP 500. I'm going to just we'll jump to a monthly chart here real quick. If we take a look at the markets, we have seen this super strong recovery. And just today, as you and I are recording this, which is January 19th, if we just draw a line across these highs, you can see the SP 500 just broke to new all-time highs. We got the stock market up. The NASDAQ's up almost 2%, SP 500 up about 1.1%. So we're starting to see a big pop. And I've been waiting for this. You and I talked about this last month about how I believe 2024 could be a terrible year for investors across pretty much every asset class except the US dollar or people who are holding US currency. And that's simply because the stock market here has been pushing higher. And a lot of people are betting on the market more or less going higher here. And when everybody gets long and they're expecting this market to keep going, it's usually when we see the stock market go the opposite direction. And if we take a look at what happened in 2022, if we take a look at these kind of just cycle highs and cycle lows in the market, so the year 2022 started near a cycle high, price was pushing up. And then more or less it ended not at the low for the year, but it ended on a cycle low. And as you can see, there's wave-like patterns that happen in the market over and over again. Those are just typical price action. But we opened on a high, closed on a low. People this year, back in the beginning of 2022, were expecting a huge rally, and they got the exact opposite. Last year, everyone was expecting the markets to continue. They thought it was going to be a bloodbath, and we ended up with one of the biggest rallies ever. And now we have got this stock market poking to new all-time highs. People are piling into growth stocks or moving into tech. and all these things. And now we got the SP 500, which to me is the broad market indicator that if the SP 500 hits all-time highs, anybody who's short, because there has been a ton of people based on our analysis and our sentiment charts, a lot of people are betting on the stock market going lower here. And of course, the market is going to do what it does best, which is try to pull money out of them, get the majority of people offside. And it does that by simply going higher, hitting new all-time highs. Anybody who's short is more or less going to have to get out, because now there's no overhead resistance. The trend is up. It's breaking out. And so they're going to have to cover their shorts, which creates a big pop like we're starting to see today. This pop could last several days. And then there's all the people who thought that that weren't in the market last year, and that we had a huge rally, and they're going to finally bite the bullet. They're going to have extreme FOMO. It's going to hit headline news, SP 500, new all-time highs. They're not going to be able to take it anymore. And they're going to be like, I got to get in. This market's taking off without me. And so it's going to suck in the last of the people who aren't long. Now, we've been long this market for several months. We've been riding this entire trend up here, which is pretty amazing. And that's the nice thing about technical analysis is we follow price. We don't try to pick tops or bottoms. We don't let our emotions get in the way. And so that's kind of where we are right now, is poking to new all-time highs. And one really interesting short-term chart, if we just zoom in here. So I've got this short-term sentiment chart that we can follow investors or active traders. And I've got these two indicators. And long story short is when we have a spike of panic selling, I have it green because usually panic selling means the market's going to go higher after. And then when we have panic buying, FOMO, that's where everybody piles in thinking the market's going to go higher, and then the market sells off. And we just had a huge bout of selling. The market got into this lime green oversold territory. It tagged the 20-day moving average. We saw the put call ratio spike to a really high level. It's telling us that not only has everyone sold their positions and the VIX spiked, so people are fearful, but they were betting a couple days ago huge with put options, betting on the stock market to fall. When you put all these things together, you see the market rip in the opposite direction. It applies maximum pain. And so this is what we follow on the markets on a zoomed in 30-minute chart like this that goes back about a week and a half. And we look at the big picture. When you put those two together, you can really get a feel of what these markets are doing. And you got to be long this market until that trend really ends.
I'm gonna come back to this maximum pain. But when the markets pop like today, when stocks in particular hit an all-time high, your next move as a trader is usually to decide whether or not this all-time high is going to persist. In other words, momentum is going to persist upwards, or we're going to have a correction, right? That's usually what you're deciding. So let's walk through your decision-making process. The indicators you're looking for to decide whether or not momentum is still on the upside. Are you looking at volume? Are you looking at put-call ratios? Are you looking at sentiment? Are you just looking at the technicals in terms of RSIs? What are you doing?
Yeah, we're looking at a lot of those. So like, I believe, like, there's a million indicators people can throw on the charts. The reality is almost all of those indicators are based on price on the chart you're looking at. So they're all taking the same data and trying to create some new type of analysis. Every piece of data that I use in our strategies is a completely different set. So I'm a technical trader, so we follow price. So we use trend analysis, we use moving averages, we use cycles. We want to see what the price charts are doing. And in a nutshell, I literally just clean the charts. I make them so they have no color. And then I just simply color code them that when we have volume flows, when we have sentiment, when we have trends in our favor, we have different assets doing different things, because money is always flowing through different defensive sectors or defensive commodities, or, there's risk on and risk off assets. Depending what all those flows are doing, I can color code these charts. And so you can see when we have, signals and moves to the upside, I have them colored red when the trend is down. And a lot of pretty much all of my analysis is fairly proprietary, but this one here, this chart on the right-hand side, this is the one that gives us a visual of what people are doing. And so when we're in a strong uptrend and we see these red bars, this is things like you just said, David. It's like panic selling in the stock market. We've got the VIX rising. We got put call ratio going out of whack. We've got short-term cycles out of favor. People are fearful. And so whenever people are fearful in betting on the market continuing to sell off, like we just saw a few days ago, the market almost always goes the opposite direction if you're in a bull market phase. And we are in a bull market phase right now. Question is, how far will that go? And it doesn't matter. There's no point in guessing, but we just want to follow these trends. And that's the key here with our analysis, is we get to see what other investors are feeling and what they're doing with their money. And when you can see what other players are, it's like playing poker and being able to look at their hands. That's what my type of analysis does. I call it inner market analysis, because we use way more than just chart analysis to pull all this together, so we can see not only what people are thinking, but actually what they're doing with their money.
What are traders responding to today? Is it economic data that came in stronger? Is it the prospect of the Federal Reserve cutting rates this year? Is it just optimism following Christmas? What's going on?
To be honest, I don't know, because I don't follow the news, but
Sure.
there's probably a piece of news out, probably helping squeeze the markets higher. But overall, I would say a big chunk. I mean, this move, we can see just from our sentiment chart, these red bars. I talked about this several days ago, saying this market is primed and ready to go higher. And so really all that's unwinding is the technicals. We're just seeing sentiment and everything unwinding as it should. You can see each time we have this, we have a very strong multi-day rally, a multi-week rally to the upside. So we're doing that. And this is the QQQ, but the QQQ just broke some very significant highs today. It popped, and now it's having this huge short squeeze, everybody's piling out of this big pop. And the same is happening with the SP 500. It's popped above, we're hitting new all-time highs. And so, a lot of times when these things happen, there is some type of economic data or news that comes out. A lot of people always say, oh, it was the news, but the reality is I can go back and you just look at the charts, and really the trends are kind of always saying that is likely to happen. It's just sometimes it takes a bit of a catalyst to spark it, but you just have to follow the price. That is the key, understanding the money flows.
Okay. Now let's just clarify for the audience who may not know you already. When you say you don't follow the news, it's not because it's not, you don't mean that you don't read anything that's going on. I think what you're trying to say is that the technicals and the charts are already factoring in events. And so you follow the price. That tells you everything you need to know, right?
Exactly. I don't put any weighting towards any news, economic data, the Fed. It really doesn't matter. Typically, if you understand the long-term trend, which direction it's going, you understand the short-term trends, there's going to be all kinds of whipsaw, big rallies, big sell-offs. And those big rallies and sell-offs along the way are usually triggered by some type of news event. But I learned years ago during the tech bubble that you can't make money really trading news.
Why aren't you an event-driven trader? I mean, if something happens in the market, let's say something, I don't know, Fed decides to do something, or I don't know, if Amazon lays off 10% of its workforce. I'm just making up examples, right? Wouldn't you want to trade on that news?
Well, no, that's a job. First of all, you never know when the news is coming out. So it's going to be like, I don't not want to be glued at a computer looking at screens and reading pieces of new headline news hitting every second. You never know when it's coming out. You never know if it's going to be good or bad. And even if you I knew economic data was going to be good or something, you never know how the market is actually going to respond. Even if you think you know what it's going to do, a lot of times it's super random, right? So to me, it's just a whole rat's nest. It's a ton of noise. It's a waste of time. If you just follow, as you and I mentioned before, the stock market is like the ocean tide. If the tide is going up and we can identify that on multiple time frames, we just know we want to be long. And those big pops and drops, we're probably already in a position. And if it goes in our favor, it's awesome. If it doesn't, it's going against the underlying trend. So it's usually a 1 or 2 day move against us, and then the market recovers and continues its trend. So I do not want to do really anything around news or fundamental data, just because to me, it's random, and you got to be watching all the time to play that.
Okay. Just to sum up your positioning, how much cash do you have right now relative to your overall position?
Depending on the portfolio,
50, 100,
Yeah, depending on the portfolio. So if you like with our passive technical investor strategy, we're 100% long the stock market still here.
Okay,
We
so
got into it. so far.
How long would you, not how long, but at what point would you consider taking some profits and positions off the table? So basically, you think momentum is still going to remain on the upside. What levels or key support levels or resistance levels rather would you want to look for before you pivot your stance?
Yeah. So we got long with this is a weekly chart of the SP 500 that I'm pulling up here. So we got long back early last year, and we've seen the market rally dramatically, poking to new highs. So we've been long for a long time, almost a year here. At this point, we just let the market do its thing. Our long-term investing strategy works very similar to our short-term. It's just it takes more time, more data for us to get a sell signal. So we continue to ride this bull market phase higher until the technicals start to break down. Then we can start ratcheting up stops more, or we can trim off profits. But right now, I mean, we are in a bull market phase, and the market is going higher. And so we just kind of follow it literally one bar at a time and reanalyze and figure out what's going to happen. So, I mean, the key is just knowing when the tide is going up. And when the tide is going down, we don't want to be involved in the market. So we avoid the corrections. And then if we were to flip it to our CGS strategy, which is more active, we're probably about 65% invested in the stock market right now. So we've been scaling out as we hit targets, like hit a 10% target of the markets, we start to scale out. And that's part of the strategy. We want to move our risk aside, and then that goes into a different ETF that generates daily interest or monthly dividend payments. So that money is sitting protected and continuing to grow because we know as this market stretches higher, the probability of a sharp pullback actually becomes more imminent.
Yeah.
And so when the market corrects and resets again, we will have already locked in profits. The trend will change. We'll get out of that trade. And we'll move into something else that goes up while the stock market is falling. So we're constantly in something that is going up. That's the key with my strategy. We don't hold stuff that's going down.
If I understand correctly, you're basically taking profits on a rolling basis. Whenever it goes up 10% or X number of percent, you take some off the table until eventually you're more comfortable just liquidating your entire position, right?
Correct. And generally, when we hit those threshold targets for, they're different for every asset because every asset is its own beast. It has its own volatility. It has its own style of movements. But as we hit those thresholds, especially when we hit all of our thresholds, almost always we see a very strong market correction after that. And so it's always nice to see, the market will typically have a very deep correction, and it'll reset the chart, and then we can get back in usually a couple months later in that particular asset and ride that next move. So that's the key, is avoiding the big moves down.
Okay, what I want to know is if we're still in the complacency stage. So remember we talked about your cycles.
Yeah.
I don't know if you have a cycle chart prepared. Yeah, there we go. That's what I'm referring to. I don't know if this rally that we've seen hitting new all-time highs is still the complacency phase, or if it's a new beginning of, I don't know, an optimism or euphoria phase, right? Is that basically, are we still there?
Yeah, I believe we're still in this this kind of complacency topping phase. And the complacency really is like that optimism belief. It's that they're complacent. They don't realize this is kind of like a rally going up. And I do believe we're going to see this market have a massive correction this year. And just to note, like if we go back and take a look at the SP 500, and let's just go to the monthly chart real quick. If we go back in time, if we go back and look at the tech bubble, at the weekly chart, actually it'll be a little bit, give us a few more bars here. But if we go back in time and take a look at the tech bubble in the 2008 crisis, you can see here the stock market rallied after it put in a top. It rallied up and it almost came right up to almost hit new all-time highs. And of course, that whole big rally there is a complacency rally, and it sold off huge. If we move over to 2008, we saw the stock market have this massive rally, just like we've seen now. And if I zoom in on this chart a little bit, you can see here, stretch it out, but you can see we broke to new all-time highs for 1 month. We poked up. We had a big wave of buying. People would cover their shorts. They get long. They're like, okay, new rally. And then the market fell, 54% from there. It sold off. So I believe we're doing the same type of thing. When we fast forward to today and we look at the chart, we've had the first kind of major correction. Momentum to the upside is more or less stalled. And this is just that poke to new highs, just like the SP 500 did last time, and will sell off. So, what you're saying, it makes a good question. Yes, we're hitting new all-time highs. You could argue we are starting a new technical bull market. It could be a stage one. It could be. But based on our analysis and a lot of other assets, we are long this because we technically are in a bull market, and it might be a stage two, which is the nice thing about technicals. We're always going to be with the trend.
Yeah.
But in my head and my bias and my analysis from the stage analysis says, okay, we're still in a major topping phase. I don't believe this is like a full breakout, another 10-year bull market happening.
I think for some of us watching, I can probably try to speak for my audience. I think I know them pretty well by now. Some people might be a little bit confused. They're listening to you saying this and they're thinking, okay, well, Chris is long with the trend, and that's been the right call actually for the last couple of months. You've been correct there. You never told me that it's going to crash imminently. You just told me that based on historical patterns, eventually we're going to get a big correction once this topping phase is over, once this complacency phase is over, right? But if we know that there's a high likelihood of this complacency phase rolling over to a correction, why would I even bother writing the trend now? Why don't I just park my cash aside and wait for that, right?
Yeah.
I guess it depends on your strategy.
Yeah, and that's a good question. I mean, I get it. I think to jump into the markets right here, you're paying high risk, nosebleed, maximum risk. I don't think there's a lot of upside left. I would not be jumping into the market right here. Put it that way. You have to be long from when the last trend started to really appreciate where we are and be sitting kind of in the positions we are. But buying right now at an all-time high, to me, is a very high risk trade. I would wait for some type of significant pause or pullback again. Could last a few weeks, depending on how that unfolds, and then reanalyze. If the market pulls back for a few weeks, has a correction, and then starts to rally again, that'll be a renewed rally. We could lock in gains in the next week or two, and then get back in a few weeks later for another leg, and maybe the stock market rallies another 10%. So, and if I think the market, I do think the market's going to have a big correction. Why wouldn't I be shorting here? Some people are saying. That is picking a top, and you never know how high a market is going to go.
Sure.
And to me, it's kind of a sucker's game. It's, when you nail one of those, when you pick a bottom or a top and you nail it, it does so much damage to your psyche and to your trading strategies, because now you think you can pick tops and bottoms, and you probably will make like 1 or 2 out of 10 that make you successful, but the other ones will just gut your portfolio. Yeah. So I just want to, I'm all about protecting capital, growing it consistently, and rotating into whatever asset is stable and moving up. And sometimes we sit on the sidelines.
If you were already long, if you're already into this market, I guess your question would be, should I take profits now? Right.
Right.
And you're saying write it up to more.
Well, I mean, we scale out, right? Like we're looking for a couple more percent on the SP 500. We'll be selling off a quarter of our portfolio in the SPY. We just locked in 10% on our QQQ position from our last entry a little while ago, and now it's pushing up towards our next target. So, I mean, there isn't like one level just saying, you don't just take profits now. There's rhyme. There's reasons to what we're doing, and statistical analysis and all this stuff that's saying on average the market moves like this. So locking in partial profits and moving your stop up here is a safe play. You definitely don't want to watch the markets roll over and give back all your gains.
Sure. Chris, let's move on to another asset class. Last time we were talking about a financial reset in 2024 that's going to bring down all these risk assets, except the dollar. You were quite positive on the US dollar. Let's talk about the DXY. Let's rehash your thesis again for why you think the dollar could do well this year.
Sure. So long story short, if we go back in time, take a look at the monthly chart for the big cycles that have been at play here. We had, the last time we went through, I think what I think is a big commodity, a big major super cycle. We saw the dollar trading way up here. Now, this was during the tech bubble. This was the tech.com bubble burst. we saw the dollar rip higher and peak out there. And then, of course, we saw a huge sell-off. And then eventually we saw the 2008 financial crisis, and the US dollar had a massive rally again. Percentage-wise, I mean, for a currency, it's a pretty big move, 25% move in a few months for a currency. And I believe we're coming back into this same type of scenario. Now, the overall trend for the dollar is really kind of just working its way higher. And I believe, we've had a strong rally. We've had a pullback. I think we're going to continue to see this push up, potentially go back to the 2001, 2002 market highs for the dollar. And really the market kind of, the dollar here built this basing formation. So stage one, and then it's kind of in stage two, trying to work its way up, and it has a series of bull flags, and the price is pointing to another big rally. And on a short-term basis on the dollar, when we look at the daily chart, we are starting to see the trend. It is starting to try to move higher here. We are really just starting to see a series of, first of all, in a downtrend, we see a series of bear flags. And those are bearish patterns. Now we have a series, we're getting into bull flags. We got a strong rally, and now we got a pause, and we got a rally, and we got a pause. And the moving averages here are starting to move higher and starting to slope up. This is the 50-day moving average, the 20-day. We have the 5-day moving average above the 20-day. All these things are telling us the upward bias is starting to go forward. And our 30-minute chart has turned green a couple of days ago, telling us the bias has shifted from bearish to bullish. So if the US dollar really is turning a corner here, and we go back to that monthly chart, we are looking at potentially a huge rally up to 116, potentially all the way up into the 120 mark, which means the stock market is most likely going to get hammered, and cash is going to become king for a while.
When the dollar moves, Chris, which other assets will be directly affected the most?
Yeah, I find whenever there's like blood in the streets, pure panic, the dollar tends to become that global reserves, global safe haven play.
Yeah.
If the dollar has a massive rally, it is going to put pressure on commodities across the board. It's going to put a lot of pressure on metals like gold, silver. So that it'll definitely be a big headwind for the precious metals space, even though they're seen as a defensive play. The problem is when we see panic selling in the stock market, and we've seen this over the last couple of weeks, our short-term charts tell us when there's panic intraday, we see gold and silver actually sell off very strong. So that's the problem when we go into a stage 4 decline or a bear market. That type of panic bleeds across pretty much all asset classes except for the dollar, pretty much, as everybody liquidates and really just tries to get away from the bear.
And let's talk about the precious metals. Gold, for example, hit new all-time highs last year, a couple times actually. Now it's above $2,000. Is gold trading in a similar pattern as the S&P, meaning we're seeing a complacency phase for gold as well, or is that in a different phase?
I think we're seeing gold. I mean, it's holding up. I would say it's got a little bit different of a price pattern. It's definitely kind of trading in a little bit of a topping phase. We have seen a nice, push higher over the past more or less year and change. And over the last couple of months, we've seen it push higher and poke to new all-time highs. We're in a very similar setup, I think, as what we saw back over here. Back in 2007, just before the stock market started the big 2008 crisis, we saw gold, silver, and miners rally and become that defensive play. And we have seen gold, silver, and miners, or more so gold, really have that rally to some regard to the upside. The problem is if we go into a bear market this year, that selling will pull gold back down. And the big question right now is the stock market going to continue to grind higher for a little while, for several weeks or several months, or start to trade sideways? And if it does, then gold has a chance to actually have a pretty decent rally still. It could pull one of these rallies out of the hat where it becomes that kind of last big push. And we see gold, silver, and miners do really well for a few months or a couple of months. And then eventually, the stock market will start to break down from the next topping pattern that it forms. And when that starts to break down, it's going to trigger panic selling among traders and investors, and then gold will pull back, and it'll get pulled down with the bear market. But it'll probably be one of the first to recover, and then we go off to this next major rally, which is the phase that every precious metal bug, gold miner person is waiting for. One of these rallies that lasts multi-years, and things rally hundreds or thousands of percent. So we're slowly getting closer, one monthly bar at a time. But I think there's going to be a ton of volatility this year for gold, in terms of it might squeeze higher for a bit, but then give it all back and then take off as one of the kind of big defensive plays late this year.
And do you think that gold miners will trade more in line with the gold bullion or the S&P? Well, I guess the S&P isn't the best barometer. It would be more like the Russell 2000, but you know my point, right? The stock market.
Yeah, I think they'll sell off with the stock market. They sell off pretty sharply. They're fast moving assets, but once we kick into a bull market phase, I think they're going to dramatically outperform the SP 500. They'll rocket higher and become one of the things we haven't seen talked about, since really 2009, when they really started to take off and get traction. So it's tough to gauge how they're going to move. But they're going to move down with the stock market, unless there is some like huge wild card that comes out where some country has got now a new, there's a global currency backed by physical gold or something that could totally change the game and send gold skyrocketing and things. But they're anything. So this is what a lot of people, I don't think fully grasp, is a lot of people get they're spread out across a ton of different assets in the stock market. They own sector ETFs, individual stocks, they own everything, index ETFs, they're all diversified. Thing is, when the stock market goes down in a bear market, almost all of those go down. And so people just need to look at the stock market as the stock market is one asset class. It's equities. It doesn't matter how many you own in there and how spread out you are. When it goes down, your portfolio is going down. So my whole theory is, when the stock market is in a bull market and going higher, we want to own equities. And I do that through simple ETFs. We own one ETF or two ETFs on the indexes. And if it's going down, we move out of equities completely and we'll go to a different asset. Could be the dollar, could be bonds if they're favorable. And that's where a lot of people really get confused. They think they're diversified and that it's going to save them, but really it actually hinders them on the upside, because any of their good trades that are doing well are countered by the really crappy ones they have. So diversifying, all you're doing is just spreading your eggs and getting really kind of, subpar returns with one heck of a roller coaster ride, versus just stepping out of that asset when it's not in favor, or betting on it falling in a bear market so you can profit. So when you look at the stock market as just one asset, you either own it or you don't. It really cleans up the whole picture of investment in my world, or
I just want to close off on another asset class, real estate. We talked about real estate quite a bit last year, but that's when interest rates are still high. Well, interest rates are still high, but mortgage rates have been coming down, and the Fed, as you know, is signaling rate cuts this year. I don't know if your outlook on residential real estate has changed somewhat since last we spoke, given the change in Fed stance, given that we're potentially seeing a pivot this year.
Yeah, so my stance is still the same with real estate. This is a slow moving beast. And I posted an article a while back. This is multifamily starts. So this is permits going through for multifamily, which is like apartment buildings or 5 units or up, and it spiked to a new high. And this also happened just before the 2008 major crisis. And really the way it is there's this huge bubble in real estate, of pretty much every type of real estate. And suddenly now things are slowing. There's a lot more supply out on the market. Prices are starting to come down. In Toronto, prices have come down 20% from the high, as the latest report from about last week. And so what happens is all these investors or home builders, they go in and they focus on multifamily, because you can build a big building on the same piece of property, fit in a ton of units. It becomes very affordable, economic. The cost of one roof covers potentially 30 units below it. So the cost, that's where the money is going. The only way at this point, in my opinion, to squeeze money out of the real estate market is multifamily. And even those are coming to a grinding halt now. I did this article, I think it was June or July. So if we take a look at single family housing starts, we can see we actually have lower peaks already and lower lows. So the single family homes have already started coming down, just like we saw over here. They started to come down 2006, 2007. We made a lower high, lower low, and it is the start of this next cycle. So all these things kind of come together. And if you merge them all together, you can see here, this is multifamily and single family. We've got a lower low, we have a lower high. That's the definition of a downtrend. So things are softening, and this usually lasts for several years. So people who are like buying a house right now, they're going to be under pressure. Home prices are going to go down. They're going to have a mortgage more than their house is worth again, and it'll be somewhat rinse and repeat. So I'm excited about the lower real estate pricing because I love real estate. I'd like to get into it and get more, but we need to let this market unwind. We need this financial reset so savvy investors can more or less reload their portfolios, get repositioned for another big move. So I think real estate is going to be difficult for anybody getting into it. Trying to flip homes or buy and sell is going to be difficult. It's going to be a buyer's market probably in 1 to 3 years.
Right.
Yeah.
Suppose you didn't own any real estate today, Chris, and you're just, you're a successful guy, whatever, you're getting into the market. Would you rent or buy today?
It would have to be a really good setup, and you got to put quite a bit of cash down to make it cash flow positive. So you got to have some good money. I mean, I've been looking at a lot. I've been working with a kid, 16-year-old kid, and another friend of mine. They both don't have real estate. They want to get into it. So we've been going through small, duplexes, triplexes, and quads, looking at them, and we analyze them. Like, where are they in town? How old are they? Like, what are the things that are
Did you
gonna
say
go?
he's 16? I'm sorry, did you say he's 16?
He's 16. Yeah, he wants to buy his first house.
Wow.
When the next
This
market
guy's
turns,
motivated. When I was 16, I was buying PlayStations, but anyway.
this kid is very patient, very smart, and so
Yeah, no
we kind
doubt.
of mapped out a game plan with him. I paid a professional years ago to rip your life apart. Everything you want to do, you want to achieve, what are you're passionate about, how much you want to work. I did all this stuff, and I mean, it led me to where I am today. It really narrows your focus of what you need to do to just hit it and do it right and do it well. So I'm helping this kid in the same way. I'm like, if we plan this out and in 2 years you buy your first house, he'll have saved up enough money. He'll be able to move into a duplex or a triplex. It'll be like cash flow positive. He'll have a place to live, and it'll get his feet wet. But I would still hold off. I think if you can hold off at least a year, you're going to be laughing because prices are going to be lower, and you're going to be able to pick up something better. Because right now it's still a feeding frenzy. If something good comes out, it's gone like in a blink of an eye. And we just need to let the supply just build up. We need people to like default, and we need all that stuff so that the homes become good deals and people are forced to liquidate. And it's a massive spiral, because what happens is we go into a bear market, people lose money, it's a recession, businesses slow down, people stop spending, times get tough, financials get tough, there's divorces, homes have to be forced liquidated. I mean, everything bad happens when a stage 4 comes together, and those who are able to sit on the sides and be able to wait and see it from the outside it's a totally different, it's an exciting time versus a fearful time. So that's the whole key in real estate, is I think a kingpin for any investor to own as much as they can when you buy it at a fair or undervalued price.
All right, perfect. Let's close off here today, Chris. Wonderful discussion as always. Where can we learn about you, your work, and your services?
Sure. Yeah. If they go to thetechnicaltraders.com, I share videos just like kind of what you and I did, but a little more on a granular level. I do that every morning for those who want to watch it. All my trades are based around asset revesting, which I wrote a book on, and it's about just only owning one asset at a time, only the best asset that is moving, that has low volatility, but is moving higher. And
Yeah.
really, I just manage my own money, and everybody just follows. You can follow the trades that I put on. And you either can follow it, or you can even have it auto traded. So if you don't want to learn trading, you don't want to watch videos, you can just have it tap into your brokerage account, executed for you, and they can take advantage of it. It's there's only about 5 to 12 trades a year. We're catching waves that roll through the market every year. We're not trading the news. We're not trading chop. So it is a nice, controlled, comfortable way to manage large amounts of money and not have to be stressed out about what's happening from a day-to-day basis.
Excellent. Thank you, Chris. Happy 2024 once again. Great start to the year, and I'll speak to you again soon.
Thanks, David. Always a pleasure. Take care.
And thank you for watching. Don't forget to follow Chris in the links down below and subscribe to this channel and like this video.